FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Well, we've been warning you for a while. The person you're about to hear from, we talked about this very eventuality that has actually come to pass. Talking about Eddie Ghabour over at Key Advisors, and what you're feeling about the market. Is it headed higher, choppy weathers, or much, much lower? We'd love to know your opinion. Just email us, kl@kerrylutz.com. That's kl@kerrylutz.com. Well, Eddie, welcome back. So we've got GM suspending dividends. We've got dividends being cut by other companies, and we're hoping that the economy is going to reopen, and it appears to be underway in 31 states, but in the rest, maybe not so much.
No, this is, there's no playbook for what we're going through right now as a country, as an economy, as a stock market. And I think this reopening is going to be a slow process in regards to getting the demand that this economy needs to get back to where it was in January and February. As you well know, I've been bullish over the years, but when fundamentals change, I change with it. I do not see a V-shaped recovery, in my opinion, on this economy, unfortunately. People's social behaviors are going to change. There's going to be stricter restrictions on certain industries in regards to social distancing. And so I think we're going to be in for a rough, choppy ride from a market perspective. I think the market got ahead of itself last month with the snapback that it's had, even though it's not near where it was at the highs of February. I think it definitely got ahead of itself. In my opinion, earnings in the second quarter are going to be worse than the first quarter. So I would be very cautious as an investor here.
So earnings in Q2 are going to be worse than in Q1, huh?
Yes, unfortunately, I think that's the case. I mean, you look at retail, entertainment, travel, restaurants. I mean, how do they even come close to getting the demand that they had prior to this? It's just almost impossible for it to be that way because, if you look at the first quarter, right, we still had good January and a pretty good February in regards to demand because we didn't really have these shutdowns till the latter part of February and then, of course, all March. So now you got a quarter here where you could potentially have a full quarter of not completely shut down economy, but, substantially hindered versus what we're normally used to as a society here in the United States.
So do you think we climb out of this by Q3 or is this going to be the new normal?
Well, I don't think it's going to be the new normal, long term. But again, I don't see this year us climbing out of this. Maybe best case is fourth quarter. Because, again, the thing you have to worry about and why it's impossible to try to predict it, I know there's people out there trying to make these predictions, but when you're looking at stock valuations, they're darn near as expensive as they were when everything was cranking. And now we're going into the rest of this year that I think people can safely say that until there is a vaccine, that we're not going to go back to normal as an economy, as much as we would like to think so. Best case scenario on a vaccine is the end of this year. And then you got to worry about how much can they produce and how fast and how much can they get, because this virus shows up again in the fourth quarter or in the fall, like many medical professionals are predicting. The question is, how are states going to react to that? Is the government going to shut things down again? God knows, I hope that doesn't happen. But if that does happen, then, you're looking at a pretty bad scenario economically. So I think best case is fourth quarter. And again, it's just too hard to predict because, again, we're in uncharted territory and no one knows how this virus is going to be in the fall. And that is going to kind of be what sets the last part of this year up for us.
Well, look, Eddie, when you look at pandemics and you look at major events, fear is the overwhelming reaction to it, the overwhelming emotion. And just like after 9/11, after 08, 09, fear drove out a lot of people and stopped you from taking advantage of opportunities Why should this be any different?
Well, I don't disagree with what you're saying. During the March sell-off, we weren't, when we made sure we were trying to advise clients not to panic and make emotional decisions. But what makes this different is this is a virus that's going to be around for the rest of this year. And do I think that there's going to be some opportunities? Absolutely. In March, we took advantage of that. As a firm, we used some of the cash and we bought some of the dips. I'm saying right now, after we have seen about a 30% increase from the lows of March to where we are now, and you look at the valuations based on where we're going to be going forward, I think you can be a little bit more patient. So when you see other dips, I agree with you. I think that there's going to be good long-term opportunities for investors. Just know this year is going to be a choppy road. And after a huge gain short term, I would be taking some profits right now and sit on a little bit of cash and buy the next dip that we will probably see, in my opinion.
Okay, that's reasonable. But we all know the old Wall Street saw, and we all know that it's very true, is stocks climb on a wall of worry, right? And when the market gets complacent, that's when the bad things usually happen, right?
You're right. And that's, take a look at where we were. We had a euphoric market in February. The best example I can give you is what kind of threw the caution flag up for us is when Apple announced in February that they were going to take an earnings hit because of China, and the stock went up on that news.
Yes.
That didn't make any sense at all from a fundamental perspective.
Mm-hmm.
And so I'm fundamentally based. I feel like things always revert back to fundamentals. At some point in time, there's sometimes disconnects, but it always goes back to fundamentals. And right now, unfortunately, the fundamentals don't justify the huge increase that some of these sectors have seen in the last month. So that's why I'm a little bit cautious after such a robust month of April. But again, I think we'll have opportunities this year, in my opinion, where you'll see market corrections and people panicking. And to your point, that's usually the best time to be opportunistic.
Mm-hmm. And yes, so opportunism should perhaps be the byword here.
That's correct. And then let's not forget, we also have an election that's probably going to cause some distractions. We haven't heard much about that because of this obviously taking precedent on the headlines. But as we get into the late summer months, you could have some headwinds from a market perspective due to election news.
Uh-huh. All right. So we can't discount the election too quickly, can we?
No, we cannot.
Yeah. So what's your take on the election? Not the outcome, but as far as further instability in the system, is that what we're looking forward to?
FSN Radio. It's all about what's next.
Lumina Gold, ticker symbol LUM on the Toronto Venture and LMGDF on the OTC, is yet another of legendary mining investor Ross Beaty's Lumina Group. It's advancing the largest primary gold deposit in Ecuador. The resource is estimated to contain 16.7 million ounces of gold and 2.2 billion pounds of copper. At just $7 US per ounce gold equivalent, it trades at an incredible 13% of its net present value. More good news is on the way with an updated PEA study expected in Q2 of 2020. It has unparalleled infrastructure. There's grid power to camp with plentiful, inexpensive hydropower available. It's close to 2 ports and is just 8 kilometers from a paved highway. Water is plentiful. It's at low elevation, and the closest community, which is very supportive of Lumina's effort, is just a 7-kilometer ride. With all this going for it, it's likely to follow the typical Ross Beaty formula, which means big returns to shareholders. Find out more and sign up for notifications at luminagold.com. That's Lumina, Lumina gold.com.
The Financial Survival Network. It's all about what's next.
In regards to how the market reacts?
Yeah.
I do. I think, I think the election is going to cause some added volatility to what we are already going to see because of this virus. And here's the other thing too, don't discount this. And again, this is not me being pessimistic or trying to scare anyone. This is being realistic that there's going to be companies in the energy space and the retail space that continue to go bankrupt and out of business. The Fed can't save everybody. And we are just now starting to get some of that news. So, it takes a few months when you have such a bad economic shock like this to start seeing bankruptcies. And that, to your point, causes some panic. And that, in my opinion, sometimes is when you want to be buying. So we have not seen the last of bankruptcies and companies that potentially default on their debt in the commercial real estate market. There's just a lot of issues right now fundamentally that have us concerned short term.
Yeah, rightfully so. I mean, you'd be a fool not to be concerned, right?
That's exactly right. But look, long term, are we going to get through this as a country? I have no doubt. I would never bet against us, but it's definitely going to be a test like we haven't seen in quite a while.
Hey, so let's go through another scenario here, Eddie. What if the worst of the coronavirus is behind us? It is, in fact, behind us. And really, that's it, kind of. It's done. What's that going to look like?
If that's done, then I would not be cautious. I would be buying this market.
Mm-hmm.
If I knew that virus was behind us, the worst of it was behind us, and we were just going to start going back to a more normal environment, even if it's a slow, gradual one, and we don't have to worry about this virus again in the fall or any of that, then in my opinion, this would be a market that I would be buying hand over fist.
Uh-huh.
I just don't think the likelihood of that is strong.
So how do you get the best of both worlds here?
In regards to getting the economy back to normal?
Yeah, let's assume that, what I'm saying is let's assume that the worst of it is behind, but it might not be. Is there a middle ground here where you can play this and get the best? If it doesn't work out, you'll do okay. But if it does work out, you'll do really well.
Well, this is why I think right now, one of the most untalked about asset classes for people to have is cash, because people are always wanting to be fully invested. Okay. And so I think that's how you can take advantage of it. And the best of both worlds is don't be fully invested, but have cash on the sideline. So that way, if you're wrong and the market has a 20% correction again after the April bounce back, that you can take advantage of it. But I think it's too uncertain to go in with both feet right now, because I can make a case for a good scenario where markets are just going to continue to go up. And I can also make a case for us not seeing the worst of it yet. And because of that uncertainty, going in blindfolded with both feet is not prudent as an investor, in my opinion.
Yeah, that makes sense. So I was just wondering if there's some trade that's going to go right both ways, regardless. And cash is always the safest. And, who is it? Ray Dalio was saying a couple months ago, the cash is trash. Well, it's been retrieved from the trash bin, hasn't it?
It sure has. And, it's interesting in regards to looking at other opportunities. One area that has held up quite well are certain technology companies, right? Because of this new normal and stay-at-home economy. And so when you look at certain companies, they've actually done just fine this year stock-wise. And so if your portfolio is overweight there, those stocks did well in a good market, and they're doing well in this bad market because the demand for their services have actually increased. So if you're overweight those sectors, I think that adds, in my opinion, a little bit of a buffer that if things don't go back to normal, that there's still going to be natural demand for those sectors. Okay. And if things do go to normal, they're still going to do well.
Yeah. Yeah. I kind of see your point there. That would make sense. But overall, you take a very conservative approach towards investing. This isn't the time to be a bottom feeder, huh?
Not after what we saw in the month of April. It was the best April, I believe, since 1987.
Yes.
And so I think there will be more corrections, in my opinion, and downside that you can buy this year.
All right. So don't go jumping at the first bargain you see, right?
That's correct.
Okay. And, as far as surviving a crash like this, when you know it's inevitable that it's going to happen, how do you get out of the market? Like, what do you do to to actually protect yourself from the inevitable here?
Unfortunately, if you're fully invested as an investor, no one can obviously predict when a crash is going to happen. But when you're fully invested, sometimes these things happen so quick you can't get out. And that's why I think anyone is crazy, again, in my opinion, to be fully invested right now when we are in uncharted territory. We have no idea how bad things could get or how good things can get. And so owning individual bonds, investment grade bonds, in our opinion, has been kind of a nice hedge, as boring as that sounds. Anyone that had those didn't feel like they were boring in March. Owning the individual bonds of investment grade companies with good balance sheet and cash. And on the equity side, companies, again, that aren't over leveraged. If you've got a lot of leverage in debt heading into this economy, you're in trouble.
Yeah. So unlever. That makes a lot of sense for sure. And cash, be ready for opportunities, be ready to pounce, because generally when you've got this kind of market, it does bounce back, but it might not go up in a straight line or a V, as you say. So anyway, well, interesting things to chew over here. Eddie, really appreciate you coming on. As always, just tell us, where do we find you and how do we connect with you?
So my Twitter handle is @CommonSenseBull, and you can also find me on our website, which is KeyAdvisorsGroupLLC.com.
All right. And there's a link to it in the show notes, as always. And hey, take a look at the site, financialsurvivalnetwork.com, Twitter feed @Kerry Lutz, Facebook page, Financial Survival Network. Make sure you sign up for a free newsletter. Eddie, always a pleasure. We'll talk to you again real soon.
Thank you so much. Be safe.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.